Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. We have a really exciting day today, full of economic news. Fed chairman is going to speak in Jackson Hole virtual meeting that they have here today. And we're going to see what basically they tell us about where interest rates are going. We'll also take a look here on this segment at the weekly report, the AI provided by Nikki the Rob, the robot advisor. We'll take a look at gold and Bitcoin as well. We'll be right back here, so stay with me here. Let's come back here and take a look at the market. You can see a great deal of volatility in the gold market today. Trading in wide ranges here, and expect that we're going to continue to see that kind of activity throughout the day, depending upon the rumors that come out of the meeting here. And so far, it looks like it's more of a dovish meeting, pushing the metals up again into what appears to be a pretty volatile market here today. Let's just take a peek here for a minute and see what's going on with the rest of the markets here. Fast market. News are coming out that Powell sees taper by the end of the year, but says there is much ground to cover before the rate hike. And so I think that's already been discounted in the market, and I'll tell you that I think one of the best news that we could hear is that interest rates may be going up, which is, I believe, bullish for precious metals. We're looking at interest rates possibly, obviously, going up, and that is essentially bullish for precious metals. What it means basically is that interest rates are interpreting the strength of the economy is picking up, and therefore the velocity of money may be entering into the market, which is inflationary, which is basically very bullish for precious metals. If the inflation move that we have seen here is not transitory, but it's more, it looks like more, especially now that we have potentially another supply chain problem developing. We may once again go into potentially what could be some really explosive numbers with regards to inflation, as we find ourselves with once again tremendous shortages and a bottleneck potentially in the supply chain. Computer chips continue to have tremendous problems with supply. So we're focusing on the monetary units, which essentially are going to be reflected in the news. Let's take a listen here for a minute to Chairman Powell here.
We should also keep in our thoughts those who have lost their lives from COVID, as well as their loved ones. Strong policy support has fueled a vigorous but uneven recovery, one that is, in many respects, historically anomalous. In a reversal of typical patterns in a downturn, aggregate personal income rose rather than fell, and households massively shifted their spending from services to manufactured goods. Booming demand for goods and the strength and speed of the reopening have led to shortages and bottlenecks, leaving the COVID-constrained supply side unable to keep up. The result has been elevated inflation in durable goods, a sector that has experienced an annual inflation rate well below zero over the past quarter-century. Labor market conditions are improving but turbulent, and the pandemic continues to threaten not only health and life, but also economic activity. Many other advanced economies are experiencing similarly unusual. In my comments today, I will focus on the Fed's efforts to promote our maximum employment and price stability goals amid this upheaval, and suggest how lessons from history and a careful focus on incoming data and the evolving risks offer useful guidance for today's unique monetary policy challenges. The pandemic recession, the briefest yet deepest on record, displaced roughly 30 million workers in the space of 2 months. The decline in output in the second quarter of 2020 was twice the full decline during the Great Recession. But the pace of the recovery has exceeded expectations, with output surpassing its previous peak after only 4 quarters, less than half the time required following the Great Recession. As is typically the case, the recovery in employment has lagged that in output. Nonetheless, employment gains have also come faster than expected. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. The unevenness of the recovery can further be seen through the lens of the sectoral shift of spending into goods, particularly durable goods such as appliances, furniture, and cars, and away from services, particularly in-person services in areas such as travel and leisure. As the pandemic struck, restaurant meals fell 45%, air travel 95%, and dentist visits 65%. Even today, with overall GDP and consumption spending more than fully recovered, services spending remains about 7% below trend. Total employment is now 6 million below its February 2020 level, and 5 million of that shortfall is in the still depressed service sector. In contrast, spending on durable goods has boomed since the start of the recovery and is now running about 20% above the pre-pandemic level. With demand outstripping pandemic-afflicted supply, rising durables prices are a principal factor lifting inflation well above our 2% objective. Given the ongoing upheaval in the economy, some strains and surprises are inevitable. The job of monetary policy is to promote maximum employment and price stability as the economy works through this challenging period. I'll turn now to a discussion of progress toward those goals. The outlook for the labor market has brightened considerably in recent months. After faltering last winter, job gains have risen steadily over the course of this year and now average 832,000 over the past 3 months, of which almost 800,000 have been in services. The pace of total hiring is faster than at any time in the recorded data before the pandemic. The levels of job openings and quits are at record highs, and employers report that they cannot fill jobs fast enough to meet returning demand. These favorable conditions for job seekers should help the economy cover the considerable remaining ground to reach maximum employment. The unemployment rate has declined to 5.4%, a post-pandemic low, but is still much too high, and the reported rate understates the amount of labor market slack. Long-term unemployment remains elevated, and the recovery in labor force participation has lagged well behind the rest of the labor market, as it has in past recoveries. With vaccinations rising, schools reopening, and enhanced unemployment benefits ending, some factors that may be holding back job seekers are likely fading. While the Delta variant presents a near-term risk, prospects are good for continued progress toward maximum. The rapid reopening of the economy has brought a sharp run-up in inflation. Over the 12 months through July, measures of headline and core PCE inflation have run at 4.2% and 3.6% respectively, well above our 2% longer run objective. Businesses and consumers widely report upward pressure on prices and wages. Inflation at these levels is, of course, a cause for concern. But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. This assessment is a critical and ongoing one. We are carefully monitoring incoming data. The dynamics of inflation are complex, and we assess the inflation outlook from a number of different perspectives, as I will now discuss. The spike in inflation is so far largely the product of a relatively narrow group of goods and services that have been directly affected by the pandemic, the reopening of the economy. Durable goods alone contributed about 1% to the latest 12-month measures of headline and core inflation. Energy prices, which rebounded with the strong recovery, added another 0.8% to headline inflation. And from long experience, we expect the inflation effects of these increases to be transitory. In addition, some prices, for example, hotel rooms and airplane tickets, declined sharply during the recession and have now moved back up close to pre-pandemic levels. The 12-month window we use in computing inflation now captures the rebound in prices, but not the initial decline, temporarily elevating reported inflation. These effects, which are adding a few tenths to measured inflation, should wash out over time. We consult a range of measures meant to capture whether price increases for particular items are spilling over into broad-based inflation. These include trimmed mean measures and measures excluding durables computed from just before the pandemic. These measures generally show inflation at or close to our 2% longer run objective. We would be concerned at signs that inflationary pressures were spreading more broadly through the economy. We are also directly monitoring the prices of particular goods and services most affected by the pandemic and the reopening, and are beginning to see a moderation in some cases as shortages. Used car prices, for example, appear to have stabilized. Indeed, some price indicators are beginning to fall. If that continues, as many analysts predict, then used car prices will soon be pulling measured inflation down, as they did for much of the past decade. This same dynamic of upward inflation pressure dissipating and in some cases reversing seems likely to play out in durables more generally. Over the 25 years preceding the pandemic, durables prices actually declined, with inflation averaging negative 1.9% per year. As supply problems have begun to resolve, inflation in durable goods other than autos has now slowed and may be starting to fall. It seems unlikely that durables inflation will continue to contribute.
Daily sell one level completed.
Inflation.
Second target 1811 activated.
Undercuts that expectation. We also assess whether wage increases are consistent with our 2% inflation goal over time. Wage increases are essential to support a rising standard of living and are generally, of course, a welcome development. But if wage increases were to move materially and persistently above the levels of productivity gains, inflation, businesses would likely pass those increases on to customers, a process that could become the sort of wage price spiral seen at times in the past.
Fast market on silver and gold. Fast market on the metals.
Broad-based measures of wages that adjust for compositional changes in the labor force, such as the cost index, Atlanta wage growth tracker, show wages moving up at a pace that appears consistent with our long-term inflation objective. We'll continue to monitor this carefully. Policymakers and analysts generally believe that as long as longer-term inflation expectations remain anchored, policy can and should look through temporary swings. Our monetary policy framework emphasizes that anchoring longer-term expectations at 2% is important for both maximum employment and price stability. We carefully monitor a wide range of indicators of longer-term inflation expectations. These measures today are at levels broadly consistent with our 2% objective. Because measures of inflation expectations are individually noisy, we also focus on common patterns across the measures. One approach to summarizing these patterns is the board staff's Index of Common Inflation Expectations, which combines information from a broad range of survey and market-based measures. This index captures a general move down in expectations starting around 2014, a time when inflation was running persistently below 2%. More recently, the index shows a welcome reversal of it. It's now at levels more consistent with the 2% objective. Longer-term inflation expectations have moved much less than actual inflation or near-term expectations, suggesting that households, businesses, and market participants also believe that current high inflation readings are likely to prove transitory, and that in any case, the Fed will keep inflation close to our 2% objective over time. Finally, it is worth noting that since the 1990s, inflation in many advanced economies has run somewhat below 2%, even in good times. The pattern of low inflation likely reflects sustained disinflationary forces, technology, globalization, and perhaps demographic factors, as well as a stronger and successful commitment by central banks to maintain price stability. In the United States, unemployment ran below 4% for about 2 years before the pandemic, while inflation ran at or below 2%. Wages did move up across the income spectrum, welcome development, but not by enough to lift price inflation consistently to 2%. While the underlying global disinflationary factors are likely to evolve over time, there is little reason to think that they have suddenly reversed or abated. It seems more likely they will continue to weigh on inflation as the pandemic passes into history. We will continue to monitor incoming inflation data against each of these assessments. To sum up, the baseline outlook is for continued progress toward maximum employment, with inflation returning to levels consistent with our goal of inflation averaging 2% over. Let me now turn to how the baseline outlook and the associated risks and uncertainties figure in our monetary policy. The period from 1950 through the early 1980s provides two important lessons for managing the risks and uncertainties we face today. The early days of stabilization policy in the 1950s taught monetary policymakers not to attempt to offset what are likely to be temporary fluctuations in inflation. Indeed, responding may do more harm.
I think we've heard what we wanted to hear, and it basically sounds like they have no idea what's going on. They're underplaying inflation, and the market is reacting to it because I don't believe that this inflation is going to be transitory. So the markets are reflecting the fact that basically inflation is going to get worse. So the landscape that we're looking at obviously is, according to Chairman Powell, raising interest rates by the end of the year, but depending upon if, as he says, certain factors come into play economically. And so, it's really, I believe they're in a tough situation in terms of calling interest rates when to raise, because if we do go into another slowdown in the economy, there is no way in the world that they're going to raise interest rates, particularly if we see this unemployment numbers explode, which I believe is going to, because the pretty much free money is ending September 1st. Unemployment, all those 7.5 million people that we looked at. We have some time here, and I want to just share with you the latest report that we published in Seeking Alpha, and it's called pretty much called "Preparing for Another Global Lockdown." Hello, everybody. This is the Equity Management Academy Weekend Podcast for August 26, 2021, titled Gold, Preparing for Another Global Lockdown. Summary. We are heading toward what could be greater volatility in the markets as we move into the later part of this year. If we go into another lockdown in Europe, it is going to cause the supply chain for many goods significant problems. On Labor Day, 7.5 million Americans will lose their unemployment aid. This is happening in the face of another surging pandemic which is spreading in Europe. Gold is trading at 1788.10, down about 290. We've seen a bit of choppiness this morning as we got some new economic numbers related to unemployment claims, which were higher than expected. They were at about 335,000 new claims. On Labor Day, 7.5 million Americans will lose their unemployment aid. This is happening in the face of another surging pandemic which is spreading in Europe to the point where they are considering closing their borders to the U.S. We are heading toward what could be greater volatility in the markets. As we move into the later part of this year, the stimulus and infrastructure package being negotiated in U.S. today is just another additional amount of stimulus, which is beginning to more rapidly erode the value of the U.S. dollar. The market appears to be anticipating that the current inflation levels are not going to be transitory. If we go into another lockdown in Europe, it is going to cause the supply chain for many goods significant problems. There's a possibility that the global economy could be locked down again. China closed their ports for a few weeks. They are reopening them, but it caused additional problems in global supply chains. The Fed may not lean towards raising interest rates during such times. They may not even talk about raising them in this environment. If anything, interest rates may be pushed lower. It does not look like raising interest rates is in the cards for the foreseeable future. Gold is undervalued compared to inflation rates right now, which are about 5%. The 10-year note is at 134. The spread is going to increase as the inflation factor becomes more dominant and permanent. We're going to see a lot of money go into precious metals, especially money that is afraid of going into cryptocurrencies because they are new and far less regulated. Precious metals appear to be set to become part of the new monetary system. The new system needs to include gold, unless everything is fiat currency and we plan to live in a fantasy world of fiat currencies and fiat values. Such a fantasy land is where we appear to be headed more and more stimulus. Even as purchasing power declines and our lifestyles are eroded more and more, real estate, stocks, and various hard assets are rising in price, not so much because they are worth more, but because the U.S. dollar in which they are priced is losing value. We trade Bitcoin, which is the leading instrument for digital currencies. it appears to be set to play a major part in the global monetary reset. On August 20, 2021, in our weekly gold report based on our variable changing price momentum indicator, the VCPMI, we said that the weekly trend momentum of 1794 was bearish as the variable changing price momentum indicator. However, the VCPMI weekly indicator was bullish with a target of 1796. The market rose to 1796, meeting the target and reaching 1812. We've been trading back down into this 1784 level, which has activated a bullish price momentum. The low was 1782.90, and the buy one level coming in today was 1783. Now, we have activated 1796 again and 1810 for this week as targets. In silver, we are looking at a buy signal from the VCPMI daily buy one level of 2363. The only thing about the signal is the conflicting signal with a weekly sell one signal of 2367. So we are in conflict between the weekly sell and the weekly buy signals. This is a mixed signal, so there is a risk if you buy or sell at these levels. With the economic meeting at Jackson Hole tomorrow, the market will be choppy today. Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes. Gold trading last 1804.70, 1804.80, up 950. We got up to about what looks to be 1809.50, and that pretty much satisfies the pattern of the 1810. What I want to share with you is that if we get a close above 1810, we're going to be looking at a higher fractal in price that closes above the monthly average price and the yearly average price of 1810, which essentially puts into the picture the following targets. The monthly target was 1876 to 1982. The yearly targets, 2164 to 2442, have been activated. Let's see what happens here the remainder of this period as we come into next month. Let's see what September brings us. In the meantime, my friends, thank you once again for the opportunity to share this with you. And I'll see you next time. Have a great weekend. We'll talk to you soon.